Guys, so this is going to be the third part of my 3-part chart pattern video series. So in this video, I'm going to talk about the double top chart pattern, the double bottom chart pattern, the head and shoulders chart pattern, the inverse head and shoulders chart pattern. I'm going to talk about the cup and handle chart pattern and the inverse cup and handle chart patterns. So basically, I'm going to talk about 6 chart patterns. So the first one I'm going to talk about right now is the double top chart pattern. So for the double top chart pattern, let's say you have a resistance over here and you have support over here. Resistance, support. So for double top, price is just going to move. Buyers are going to push price up and it's going to meet a level of resistance. Then sellers will come in and push it back down to the support. So over here you have a one top over here. So the next thing that is going to happen is that buyers will now push the price up again to resistance and sellers will push it back down to support. So that's why they call it double top, because you have double top here. So double top chart pattern is a bearish reversal chart pattern, especially in a downtrend. So you should be looking out for this chart pattern in a downtrend. Let's say this pink line that I drew over my chart is the 200 period moving average and price is below it. Then you know that you are in a long-term downtrend. So once you spot this chart pattern on the in a downtrend, you should be more bearish about the market. You should be looking for selling opportunities, shorting position, take short positions. So after the price has come to the level of support over here, so if the price did not just break above it, or it broke above it, it broke below it, sorry, if the price did not break below it, or maybe it broke below it and moves back up into the channel like this, then what the next thing that is going to be forming, so you know this is a first breakout, so the price could just first break out and move back into the channel and make a new high. So you just reference this high over here. So what is going to happen next is that price is going to be moving through that range. It's going to be going down, up and down within that range, and the volatility is going to reduce. So what is happening over here is that you have a build up. This place over here is a build up. This place over here is a build up. So it's actually just telling you that buyers do not have the enough momentum to push the price back up towards a resistance. So at this point over here, sellers are in control around your support. So the next thing that is going to happen, more likely, especially if the price is in a downtrend, that's below 200 period moving average, is that you are going to have a breakdown of price. So the price is going to break down. That's why we call it bearish reversal chart pattern. Let me try and illustrate that again. So you are going to have a support, a resistance, support, and the price is going to make a top. Buyers are going to push it up to resistance. Sellers will come back, push it down back to support, and you have a top over here. So buyers will now push it back to resistance again, So basically, buyers and sellers are just fighting to gain control over the market. Then sellers will now push the price back down to resistance. So at this point, you have a double top. You have one top and double top. So at this point, buyers will now start trying to push the price up, but they won't be able to have that strength again to push it back to the top again. So they might just be able to push it down to this level, and sellers will come in again and push it down back to support again. So at this point, you have a new high to reference. So this now becomes your resistance, because price is going to be moving within that range. Price is going to be moving within this range like this and back down before it breaks down. So over here, over these ones, volatility is high. Buyers and sellers are pushing price with huge momentum, but over here, sellers are in control. They are taking breath out of the buyers around support, and buyers are losing strength to push the price further up, and sellers finally gain control and push the price down. So the next thing that is going to happen, in case you want to take this trade, you want to short this market because it's a downtrend and a double top is a bearish reversal pattern. Then what you do is that you wait for the price to come to support. Then you put your stop loss 1 ATR above this build up over here. This thing you have over here, this lower volatility area, is build up. So you put your stop loss 1 ATR above it, and you short the market. So that's how you short the double top chart pattern. So the next chart pattern I'm going to talk about is a double bottom, which is opposite of the double top chart pattern. So double bottom is a bullish reversal chart pattern. It means when you see it on your chart, it's telling you that the price is going to reverse towards the upside, especially in an uptrend. Remember, always trade with the trend. So for example, if it's an uptrend, the price is above a 200 period moving average. So you want to be more positive about a double bottom chart pattern because it's a bullish reversal chart pattern and you are trading it with the trend. So what is going to happen with a double bottom chart pattern is that price is going to break down and hit a level of support, and the next thing, buyers are going to push the price up. Buyers are going to push the price up and it's going to hit a level. So the next thing that is going to happen is that sellers will now try and push it back down again to support, and buyers will push it back to resistance. So what do you have here? You have one bottom and double bottom. So you can just see that it is just opposite of the double top chart pattern. It just means if you turn the double top chart pattern upside down, you get a double bottom, which is a bullish reversal chart pattern. So for this chart pattern, and over here, if the price did not just swiftly break above this, or maybe it broke above it and move back to the channel, you are going to see the volatility of the candles reducing. Volatility of the candles are going to be reducing. Let's say you'll be having, so seller will try to push it down, but they won't have strength to push it, and buyers will take it to resistance again. Then sellers will try again to push it down. Then finally buyers will take it above higher. So buyers are finally taking control over the market. So over here, you are going to be having something like a build up over here. The range of the candles over here are going to reduce compared to the range of the candles over here. and that is bullish. So if you want to go long on this chart pattern, you just put your stop loss 1 ATR below this swing, and you can long when the price comes to your support over here. So that's how you trade the double top chart pattern. So the next chart pattern I'm going to talk about is the head and shoulders chart pattern. So for the head and shoulders chart pattern, you have something like this. You have price make a high. So it's a bearish chart pattern, just like double top chart pattern. So price is going to make a high. Buyers are going to push it up and sellers push it back down to the level. Then sellers will push it back up again higher than this previous one. They will now push it back up, and will now push it back up, and sellers will now take control and push it back down to this level. Then buyers will push it back up to this level of this high over here, or a little bit higher or lower. Let's say a little bit lower, because if it's higher, it means the chart pattern is being invalidated. So then sellers will push it back down. So what do you have now? You have resistance over here. You have resistance over here. So we call this the left shoulder, we call this the right shoulder, and we call this the head. And this brown line at the bottom is called the neckline. So that's why we call it head and shoulders chart pattern. The left shoulder, you have the head, and you have the right shoulder, and you have the neckline as a support. So this chart pattern is a bearish reversal chart pattern. It means if you see it in a downtrend, if you see it in a downtrend, like price is below 200 moving average, then you should be looking to short the breakdown. So what will now happen is that after the formation of this left right shoulder, buyers are going to try and push the price up. Then sellers will take control, push the price back down to resistance. You can see that now it has made a lower high. This low is lower than this low, so it has made a lower high. So buyers will now try again to push the price up again, but each time they push up, the momentum, the strength they have is reducing, and sellers will now push it down again. So what you have over here is a build up again. You are going to have a little consolidation over here, like a build up around the support. Then before sellers will now finally push the price down. So because this is a downtrend, like price is below 200 period moving average, you want to be a seller when you see this kind of chart pattern. So that's it about a double. So in case you want to go short, you can look to enter at the top of this resistance over here, and you place your stop loss 1 ATR above the resistance. So that's it about a double head and shoulders chart pattern. So the next chart pattern I'm going to talk about is the inverse head and shoulder. That is the inverted head and shoulders. It's just the opposite of the normal head and shoulder that I just discussed. So for that one, you are going to have a sellers push price down like this to this level, then buyers push it back up to the level that the sellers push it from, almost the level. You could see a little bit variation, but the main thing is to note that, to just identify the pattern. So you then sellers will now push it back down again. So at this point you are going to have a lower low. So this low over here is lower than this one over here. Then the next thing is that buyers will now push back the price again to this level over here. Then sellers will now once again push it down again. You can see it is opposite of the normal head and shoulder chart pattern. This one is just when you turn the normal head and shoulders chart pattern upside down, this is what you are going to get. So it's going to look like this, and you are going to have a neckline. So the neckline is basically your resistance. You can see you have the left shoulder, the head, and the right shoulder, and you have the brown line over here as your resistance. So the next thing that is going to be happening is that volatility is going to be reducing over here. So sellers will try to push it down, but they won't be able to push it down that much, and buyers will take control. So you want to be trading this chart pattern in an uptrend because it is a bullish reversal chart pattern. So sellers will try again to push it down, but each time they try, their power, the momentum in their move is reducing. So over here you have something like a build up around resistance. You are going to have a build up around resistance, and sellers will now try to push it down again, but each time they try, buyers take more control, and finally, because it's an uptrend, buyers will gain control and push the price higher above a resistance. So that's how you trade it. So for example, if you want to trade this chart pattern, you want to enter around the trend line resistance over here, put your stop loss. You want to go long around the trend line resistance and put your stop loss 1 ATR below the trend line support, and put your stop loss 1 ATR below the swing low of the trend line support. So that's it about double head and shoulders chart pattern and inverted head and shoulders chart pattern. So the next chart pattern I'm going to talk about is the cup and handle chart pattern. So for the cup and handle chart pattern, you are going to have something like this that looks like a cup. You are going to have something like this. Yes, something like this that looks like a cup. Then price is going to be moving through it like this, like this, like this. So basically price is going to be trading within it. Price is going to be trading within it, and then price will start forming something like a consolidation over here, a build up. So that's when you now have your handle. So your handle is going to look like this. Your handle is going to look like this. So you see it's over here is the cup, and over here is the handle. So cup and handle chart pattern is a bullish reversal chart pattern. It's a bullish chart pattern. So price is going to just basically be trading within this place, within this range. Then it's going to move into this range, and volatility is going to reduce. So if you see this chart pattern in an uptrend, that's when price is above a 200 period moving average, then you should be looking for buying opportunities. So basically what is happening over at the handle is build up, that is a consolidation. So if you want to buy this, if you want to go long on this chart pattern, you put your stop loss 1 ATR below this low, and you put your buy limit order around the support, and you go long. So the price will finally break out like this because it is a bullish reversal chart pattern. So that's your cup, normal cup and handle chart pattern. So the next chart pattern I'm going to talk about, so for this one, you can just say this your resistance, this your support, and the swing high of the price is your resistance. Let's say here is your resistance. So that's it about a cup and handle chart pattern. The next chart pattern I'm going to talk about is inverted cup and handle chart pattern. So that's just of normal cup and pattern. So for that one, you are going to have price moving like this. So price is going to, you are going to see a chart pattern like this, and you're going to see candlesticks pattern moving inside the range inside it like this. So it's going to be something like this. So just visualize this zigzag line that I'm doing as your price movement. Is that the price is going to start forming a handle. So that's when you have your cup, inverse cup and handle. So you have something like a ascending channel over here, and price is just going to be moving within it, and volatility is going to reduce. So what is going to happen next is that, let's say this place is your, let's say this place is your, okay, let's use here, let's say this place is your support and this place is your resistance. So this, if you see this an inverse cup and handle chart pattern in a downtrend, is telling you that the price is going to break down. So the price will just be moving like this towards this place, moving the cup with higher volatility, moving within the range of the cup. Then once it enters the handle, volatility is going to reduce and you are going to have something like a build. So it's when it starts moving within the handle. So buyers and sellers will be, they are both trying to gain control of the price. Then the to have is that buyers are going to take control and push the price down. So if you market, then you want to enter line resistance, place your stop loss 1 ATR and wait for the market to break down. So it's usually very powerful bearish reversal chart pattern in a downtrend. That's when price is below 200 period moving average. So that's all for this chart patterns video series.